although it's not needed, for me it's a pleasure to introduce Bill Dudley. Bill worked at Goldman Sachs from '86 to 2007, where he held the position of chief U.S. economist. In 2007, he joined the Federal Reserve Bank of New York. There, he served as president from 2009 to 2018 and vice chairman of the Federal Reserve Open Market Committee. In 2019, Dudley joined the Griswold Center for Economic Policy Studies at Princeton as a senior research fellow. So, hello, Bill. It's a pleasure to talk to you. I'd like to start with the first topic on the new framework, the new monetary framework of the Fed. So it was built and conceived partly when you were there in a different environment, environment of pre-pandemic world where we had all this discussion on disinflationary pressures, low neutral rates, and then it came about after all these, after this intense shock with the pandemic and all the fiscal expansion. And there we have a checklist with too many items that the Fed has to check before considering a lift-off. We have inflation, we have that seems to be more than checked, and then we have the labor market where we still have some room to go. I'd like to hear your thoughts on that. Is that too many conditions for this post-pandemic world where fiscal policy is more active and we have all these supply disruptions? Let's start with that and then we go on.
Well, that's obviously a good place to start, and it's a big question. Thank you for having me here today. I think that first thought I'd leave you with is that the changes in the long-term framework made quite a bit of sense, because what was happening was the Federal Reserve was missing its 2% inflation objective to the downside persistently for a long period of time. And that was causing inflation expectations to start to sink below their 2% objective. The danger here, of course, is that if inflation expectations are sinking below 2%, that makes further low inflation readings more likely and increases the risk that the Federal Reserve doesn't have much room to cut interest rates in the next economic downturn. That the Fed finds itself in a situation sort of like Japan, where you're trapped at the zero lower bound for interest rates and have trouble actually providing enough monetary policy stimulus to generate an economic recovery. So the Fed made a change. They basically said, no, we're no longer going to target 2% inflation every period. The old policy was what is called a bygones policy. In other words, if you miss yesterday, you still try to hit 2% today, and you just keep trying to hit 2% regardless of how long you've missed. The new policy is to take into account past misses. Basically say, if we've missed consistently to the downside, we're now going to try to miss to the upside so that people understand that we're targeting 2% inflation on average. And if people view that as credible, then that will keep inflation expectations better anchored around 2%. So that was the motivation for the policy. And I think the motivation for the policy was a good one. So I think the shift in the long-term monetary policy framework was well justified on behalf of the Fed. The issue for me is how the Fed has actually operationalized that. The Fed has basically said that they are going to operationalize that by not lifting off until they've satisfied three conditions. Inflation has reached 2%. The Fed has assessed maximum sustainable employment. They've reached that. And that they're confident that inflation is going to go above 2% for some time in the future. So what that means is that the Federal Reserve is going to be at 0 to 25 basis points for the federal funds rate target at a time when when the economy is already at or beyond full employment and inflation is at 2% and likely to go above 2%. This, to me, creates some risk that the Federal Reserve is going to be late because they're not starting to tighten monetary policy from a very accommodative setting until the economy is really far along in terms of its economic recovery process. The consequences to me of this is the Federal Reserve, when they finally start, will have to do more. Interest rates will have to go up higher than they were before. And the risk of a hard landing will go up because the Federal Reserve finds that the unemployment rate has fallen too low. below a level consistent with 2% inflation over the long run, the Federal Reserve will have to push the unemployment rate back up. And that's very difficult to do. Historically, the Federal Reserve has had a tough time pushing up the unemployment rate a little bit. Typically what happens is once it's gone up more than a couple of tenths of a percent, the next stop is a full-blown recession, and with the unemployment rate going up 2, 3, 4 percentage points. So it's a risky strategy, I think, in terms of how they've actually operationalized it.
Great. Good points. So I have two questions for you following what you just said. So it's very hard to square the consequences of what you just point out of this framework to what we see at the U.S. yield curve at this point, right? I would say if you go, I mean, I think the behavior of the yield curve has really puzzled market participants and academics alike, given the circumstances and given the framework. So how can you put together your view on the consequences of this new monetary framework and what we are seeing at the yield curve? Is there an economic interpretation that we can extract from what we are seeing in the yield curve in the sense that, well, markets are giving us some signals that neutral rates are going to end up being much smaller than we previously thought, and the disinflationary risks are actually greater than one would expect to come out of this new monetary framework? Or is there something else? Or is there some technical issues that is driving the yield curve south? Is the Kiwi playing a too effective role in defining the yield curve at this point? So I'd like to hear your thoughts on that. And second, can you give us your outline of the next steps of monetary policy throughout 2022 and 23 and the risks associated with this baseline scenario?
So I think you have it exactly right. The yield curve is a little hard to interpret at the current point because the Federal Reserve has basically said they want to push inflation above 2%. And the Federal Reserve has also said that they think a neutral nominal federal fund rate is in the range of 2 to 3%. So that would suggest that the peak in funds rate in the cycle is going to be 3% or more. Yet if you look at the Eurodollar futures market, the peak in rate looks to be around 1.5, 1 3/4%. So the markets are telling you that the Fed's not even going to get to a neutral monetary policy, let alone a tight monetary policy. The other aspect of this, of course, is the 10-year Treasury yields. If you had told me that we were in an environment of a recovery in the economy, large amounts of fiscal stimulus, inflation rising at 5.3% on a year-over-year basis in the United States on the back of today's CPI report, and that 10-year Treasury yields would be 1.3%, I would say that's virtually impossible. That's where we are. So how do you square the circle? Well, there's two possible explanations, I think. The first explanation is people just think that the Federal Reserve is going to have trouble getting the economy to full employment. It's hard to make monetary policy easy enough for long enough to push the economy back to full employment. That seems like a pretty, tough thing to buy into, given that we've already gotten down to a 5.2% unemployment rate, and the fact that the fiscal tool is much more available now than it was, say, in the recovery from the great financial crisis. The other explanation, which you alluded to, is that maybe quantitative easing is really responsible for this. The Fed buying $80 billion of Treasury securities a month and $40 billion of agency mortgage-backed securities a month is basically forcing people to buy other assets. And as they buy other assets, that pushes down long-dated yields and pushes up the stock market and pushes down credit spreads. And so the quantitative easing may be more powerful than what we anticipate. I mean, if you think about how quantitative easing works, it basically, the Fed buys these long duration assets from the market. And when it does that, it's creating reserves at the Federal Reserve and deposits at the Federal Reserve that people don't really want to hold. People are being forced to hold deposits that they don't really want to hold at the Fed, which earn virtually nothing. And so they're trying to earn more. And when they try to earn more, they go out and buy these other longer dated assets. But when they buy it from someone, they're creating a deposit. And so everyone's trying to get out of holding the deposit at the Fed as they search for yield and get pushed into other assets, bonds and stocks. So I think it may turn out that quantitative easing turns out to be more powerful than we've anticipated. Now, that said, the Fed is going to be turning off the quantitative easing engine pretty soon. There's a recent article in the Wall Street Journal by Nick Timiraos, which I think outlines what's going to happen in terms of tapering. As Nick Timiraos outlines the Fed thinking, September they'll signal that they're even closer to beginning the tapering process. At the November FOMC, they'll announce the start of the taper. They'll do it in probably 10 billion steps monthly for treasuries, 5 billion a month for agency MBS. And by doing it on that pace, they'll be done middle of 2022. And I think, the real message here, I think in terms of tapering, is that the Fed wants to get done by the middle of 2022 because they're not certain about when they're actually going to want to raise short-term rates. They're not really sure how quickly they're going to get to the point where they satisfy those three conditions that we talked about earlier. Some people on the Fed think that they could get to that place by the second half of 2022. And if that's the case, you want the taper to be complete by then, because it'd be very odd for the Federal Reserve to be continuing to buy assets and at the same time raising short-term interest rates, because buying assets is providing monetary accommodation, raising short-term rates is removing monetary accommodation. So it'd be very odd to do both at the same time. So I think there's a pretty strong presumption that the taper has to be completed first before the Federal Reserve lifts off. I think the Fed's going to follow exactly the template that they followed last time. First, you taper down to zero, then you raise short-term rates a bit, and once you've gotten short-term rates up to, say, 1.5% or so, then you start to normalize the balance sheet, you start to let maturing securities run off, and then the balance sheet starts to gradually shrink. Now, it's going to take a very long time for the balance sheet to get back to where it was in February 2020 before the COVID pandemic started and the Fed started to do massive quantitative easing. But that's the third phase of the process when the Federal Reserve starts to shrink its balance sheet.
Oh, very good, very clear. So to sum up, one way to view what's going on in the yield curve is, well, QE is being very effective. The Fed should not read the yield curve for an economic story that would push them to be more careful in terms of deciding to move on with tapering. But if that is true, you don't have this concern on these inflationary issues that the yield curve might be telling, or disinflationary risks that the yield curve might be telling you. But on the other hand, a taper might have a pretty strong effect on the yield curve, if that's the case. Do you think the tapering process might have this effect, or it would be more effective further on the road when you discuss the reduction of the balance sheet? How do you see this sensitivity to these technical issues? I think it's hard to know exactly how people are going to respond to the taper. I mean, I think we're very cognizant of what happened in 2013 when Chairman Bernanke mused about the start of the tapering process, and that caused quite a bit of upset in the markets because people started to revise their expectations of when the Federal Reserve was going to tighten. I think this is a little different because we have that template from 2013 to 2019 to guide us, and we know that the Federal Reserve is going to be pretty careful about how fast they actually raise short-term interest rates, that they have these three conditions that have to be satisfied before liftoff occurs. And so I think that will keep expectations better. So I think the fact that we have the experience of last time should reduce the risk of a taper tantrum. Also, the Fed has been so careful in terms of their communications this time, and they've talked about tapering before they're actually doing the taper. It just shows that how aware they are
of what happened in 2013, and they don't want that to happen again. They want the process to be smooth, and we'll have to see how it plays out. Another big issue, I think, in the market, looking at the Treasury bond market, is what happens to two other issues. What happens to real interest rates, which are extraordinarily low right now? If you look at the 10-year TIPS yield, it's minus 1% or so. That's an extraordinarily low real yield relative to history. So that's another issue. And the second issue is, which is related, is what should the bond term premium be? Historically, if you go back prior to the last business cycle, the spread between 10-year Treasury note yields and 3-month Treasury bills was about 100 basis points. So 10-year Treasury yields were, on average about 1 percentage point higher than 3-month bill rates. In other words, there was a risk premium on Treasuries because people were worried that if I hold this long duration asset and inflation rises and the Fed tightens, I could take losses on those long duration assets. That changed after the great financial crisis. People started to view the bond market as a hedge against bad economic outcomes that could cause the Fed to be pinned at the zero lower bound for interest rates. So bond risk premium from, say, 2012 onward were at zero or even negative. And today, bond risk premiums remain very, very low. To me, it's going to be an interesting question whether bond risk premiums start to go up a bit as people become more aware that there's a sort of two-sided risk. Yes, there's still the risk of being pinned at the zero lower bound if the economy gets hit with a shock, but it also strikes me that there's a risk that the Federal Reserve could be late and inflation could rise above 2%. In that environment, the bond market wouldn't be a hedge for the higher inflation, would be a bad place to be.
Great. So let's move topics a little bit. There's the current debate on all the inflation that we have been seeing in the U.S. and the view. I mean, we have a few items that are clearly transitory, but there's this debate. So, is this a pure transitory inflationary pressure that after we see the reopening and everything smooths out, we're going to be back to the standard world, or we have a chance of long-term inflationary pressures and some de-anchoring of the inflation expectations. And what's your view on the behavior of inflation expectations in order to make these inflationary dynamics more inertial and have long-term effects, given that inflation expectations are endogenous to monetary policy and to the monetary framework that is in place right now? The Fed seems to be very comfortable with the behavior of inflation expectations, but it's endogenous to his comfort that this is going to be well behaved. So I'd like to hear your views on how do you see this evolving and what are the risks associated with that?
Well, I think it's clear that a good chunk of the inflation that we're seeing is transitory. I mean, the sharp rise in used car prices, we can identify what's causing it. It's due to the chip shortages that are inhibiting new car production, and it's due to the fact that rental car companies that unloaded a lot of their inventory cars during the height of the pandemic now need more rental cars because they're seeing more business. I think Chairman Powell in his Jackson Hole statement, basically made it very clear that there is something that's very anomalous right now about what's happening to durable goods prices. The last 25 years, durable good prices fell, not just over that entire period, but in every single year. And over the last year, durable good prices have gone up quite substantially. That almost certainly will, normalize over time, and so we'll see durable goods prices go back down. But I think that, even though a good chunk of the inflation we're seeing today is likely to be transitory, that doesn't mean that we're necessarily going to avoid a longer-term inflation issue. And to me, the issue is really something I think that you were alluding to, which is about confidence in the Fed. If people start to, react to the transitory inflation by revising up their inflation expectations, that in itself will tend to increase inflation on a going forward basis. Chair Powell in his Jackson Hole speech talked about two things that would make him more concerned about inflation. Number one, what happens to wages and salaries, and number two, what happens to inflation expectations. expectations. In his speech, he basically argued that inflation expectations and wages were still pretty well, contained. But since his speech, some of the more recent readings on inflation expectations, I think, have become more concerning. For example, yesterday, the New York Federal Reserve Bank announced the most recent results of its household survey, which includes some questions on household inflation expectations. And the one-year inflation expectations hit an all-time high for the survey, which goes back to 2013 of 5.2%. And, that's understandable given the inflation rate we're seeing right now. But more importantly, the three-year inflation expectations, which looks to be got beyond that a bit, was at 4%, well above where it's been in the history of the survey. So, if inflation expectations start to become unanchored to the upside, we'll probably actually have a bit of an inflation problem, even if the Fed Reserve was right in their original judgment that the durable goods price increases that we saw are in fact going to be transitory. And I think the risk here is of people losing confidence in the Fed is exacerbated a bit by the Fed's change in their execution of monetary policy. The fact that they've tied their hands and said, we're not going to raise rates until we satisfy these three conditions: full employment, 2% inflation, and confidence that inflation is going to go above 2% sometime in the future. The fact that the Fed can't even start until those three conditions are satisfied, might reinforce this potential loss of confidence in the Fed. So I think watching inflation expectations, will be really important in the weeks and months ahead. And I think also watching what's happening to wages and salaries. On that score, the news on a year-over-year basis has been, pretty, has been not particularly worrisome. But if you look at the most recent readings, they have been a bit higher. So I think that the wage and salary is also an area where we have to keep our eyes on.
So still on inflation expectations, coming from a country like Brazil and any emerging country, we have at least in my experience as a policymaker, we were a little bit obsessed with deviations of inflation expectations from the target. That was where we had really a major concern, and where our policy stance would change rapidly if we saw something that was out of line with what we expected. So we were, I think, central banks in countries like Brazil and our board, as an example, were very reactive to inflation above the target. The Fed is a different ball game. It's the Fed. It's where it's everybody believes we have full credibility there, and we still can see some movements in inflation expectations and attribute it to current inflation or to that this deviation would be temporary and the Fed has full credibility. So how do you see, as being there at some point, what would trigger a reaction in terms of inflation expectations? Is there some zone where you see and say, well, that's too dangerous. Let's re-optimize, let's forget a little bit on the framework, and let's go back to the basics and think about anchoring again. Of course, this is far from the baseline scenario.
I think to your point, it's probably, the Fed has the advantage that inflation has been well behaved for a long time, and so presumably the inflation expectations dynamic is pretty sturdy, and so it takes a pretty big shock to cause inflation expectations to rise in a significant way. So the Fed is starting, from a good point in terms of keeping inflation expectations in check. But, Chair Powell's speech is very clear on this point. If inflation expectations and wage and salary inflation climb to levels inconsistent with their 2% average inflation target objective, then the Federal Reserve will be forced to respond. And in that environment, the Federal Reserve would have to raise rates probably by more, and it probably would happen sooner than what people anticipate. One really big question for the economic outlook, for example, right now is how tight is the labor market? On one hand, we have still nearly 6 million jobs, less jobs in the United States today than where we were in February 2020. That would suggest that the labor market has considerable slack today. And the unemployment rate is 5.1 or 2% compared to the low point we reached in February 2020 of 3.5%. So that would also suggest there's quite a bit of slack. But then if you look at other measures of the labor market, it looks like we might not have much slack at all. There's a report that comes out called the JOLTS report, Job Openings and Labor Turnover. And right now, the most recent report that came out, I think it was last week, the number of unfilled jobs, so the businesses that have jobs but can't find workers to fill them, is at record high, 10.5 million unfilled jobs in the United States. That tells you that the labor market's actually pretty darn tight. So one of the key issues is going to be whether was last time an anomaly. I mean, if you think about what happened last time, we had a pretty slow economic recovery, and inflation stayed very low. And the Fed could get to a lower unemployment rate than they expected without that generating negative consequences in terms of upward pressure on wages and upward pressure on inflation, inconsistent with the Fed's 2% objective. But just because the unemployment rate you could get to last time turned out to be lower than you expected doesn't mean that will necessarily happen this time. And so there is some risk that we find out that the labor market's tighter sooner than we anticipated. And in that case, again, that would force the Federal Reserve to respond more quickly. So I think watching inflation expectations, watching developments in the labor market are going to be very critical to determining whether the Fed is forced to move more quickly than what people generally expect, and by potentially more than what people expect.
Very good. Let's again change a little bit the topics and talk about the stars. Not the stars, but our stars and this long-term neutral real rates in the U.S. I mean, the discussion where it is and where it's going has been there for a while. I remember when you were there in 2018, we had all this debate regarding our star, where it is, and in the process of tightening that the Fed was experiencing there. My first question is, in my view, markets and even the Fed was a little bit surprised by realizing that this tightening in the beginning had too much effect, in the sense that it was enough to cause some reduction in activity, and one might infer that our star was lower than previously thought at that point. And that shows how much uncertainty do we have on these star measures and things that are not observable in the economy. Is there a fair description of what happened there? And that's my first question, but that's not the most important. And I think I'd like to hear your views on how do you see our star evolving in these during the pandemic year of 2020 and after that, with all the fiscal reaction, the reopening, and all that we are seeing at this point?
So I think, what happens to our star in the sort of neutral, the interest rate consistent with a neutral monetary policy regime is, hugely very important for the trajectory of interest rates in both short and long-term fixed income markets. I think that you're right that there was a bit of a surprise, coming out of the great financial crisis, that the neutral monetary policy regime was, at a lower level of short-term rates than what the Fed had anticipated previously. I think that the general view is that there's a number of different drivers of this. Number one, demographics, the aging of the population, so more savings, less investment, and so that pushes down the level of equilibrium interest rates. Number two, increase in global inequality. As you move money from moderate income people to high income people, you tend to drive up the aggregate savings rate, so that also pushes down R star. And the third issue is what happens to productivity growth. If productivity growth is high, like it was in the late 1990s, I think that tends to be associated with a higher neutral rate. If productivity growth is lower, then I think that has downward effects on R star. So let's take a look at all three of those things. Well, the demographic trends are sort of baked in the cake. So the aging of the population isn't going to have significant consequences for R star, except the fact that we're entering a period where a lot of people are retiring in the United States as the baby boom reaches retirement age. And so that actually could tend to push R-star up a bit because savings rates tend to fall when people actually enter retirement. The second issue on R-star is wealth inequality. Well, that really is going to depend a little bit on whether the Biden administration in the United States is successful in raising taxes on the rich and using those funds to provide programs for lower and moderate income people. For example, making the child income tax credit permanent. If the Biden administration is successful in doing that, that should lower the aggregate savings rate in the U.S. and that should raise R-star. And then the third issue is productivity growth. And I think that's the one where, very difficult to forecast what's going to happen to productivity growth. I personally think that on one hand, there's some positives like the digitalization of the economy, all the things that we discovered about how we can do business during the pandemic, I think probably have some positive implications for productivity growth going forward. So I think, the productivity growth outlook is also, very, very important for how R-star plays out. Right now, market seems to think that R-star is somewhere around 0 or maybe slightly positive. If inflation is 2%, that means a neutral nominal federal funds rate is 2.5%. I wouldn't quarrel with that, view, but that's based on not a lot of information and very different economic environment than we had last business cycle.
A very thorough explanation, but let me get back to, there's this argument in a paper that supports this argument that after every tragedy or period of a lot of uncertainty, like wars, pandemic, or natural disasters, society increases savings because people experience a lot of hard times and they save in response to that. And then after 2020, we should see a similar pattern. And actually, we've seen a considerable increase in savings during this period, but might be a consequence of all that we've done in terms of transfers and the inability to consume during this period as well. So that would push to a lower R-star in the near term, because we have a change in preferences. Because
I think it's one thing that people want to consume but don't because they're worried about the COVID virus. I personally think that the household sector is in very different shape now than compared coming out of the great financial crisis. Coming out of the great financial crisis, people in the United States were burdened with a lot of mortgage debt and home prices had fallen, and a whole bunch of people, their homes were worth less than the mortgage debt they had in their homes. This cycle, I think, is very different because there was massive fiscal transfers during the pandemic. And if you look at what happened to the money where the government wrote checks to the households, it looks like about a third was spent, a third was saved, and a third was used to pay down debts. So while a segment of the U.S. population is still very badly off because of the pandemic, they lost their jobs and they're in great difficulty. If you look at the household sector in the aggregate, it's actually in really good shape to sustain spending because the household savings rate rose as we went through the pandemic. And I think there's probably a lot of pent-up demand, to travel and to do things, go to movie theaters, do a lot of, the leisure and hospitality stuff that people couldn't do during the pandemic. So I actually think, the last business cycle is not a good template for this business cycle because the household sector, I think, is coming out of this downturn in much better shape. And I think that's also true with the corporate sector. I look at the corporate sector, part of it's the very low level of interest rates. You look at the debt service burden for households in corporate America, it's at record lows. So, low level of interest rates, is not very burdensome to people who have debt right now in the United States.
Great. That was the direction I was going. This time is different because all this hardship came with a lot of transfer. Income actually went up. And if anything, people in the United States learned that when you have a disaster, you might become richer. So you probably have little motive to save for the rainy day. So you might have an incentive to leverage up even more, and that would drive our star up, not down. The pent-up demand should be higher than what people are expecting, because you're not going back to the previous world. You're going back to a world with less savings. Is that forcing too much the argument?
I think there's definitely pressure on that side. I think there, though, is something on the other side, which is at this low level of interest rates, you sort of ask yourself, what's the rate of return on financial assets going to be over the next decade compared to the last decade? It's probably going to be a lot lower. People save to obtain enough, of a financial cushion so they can, fund their retirement. And so if financial asset returns over the next decade are much lower because real rates are so low and asset prices are already so elevated, I think that might push in the opposite direction of forcing people ultimately to have to save more. But first, they have to actually realize that they're not going to get the kind of asset returns over the next decade that they got over the last decade.
Oh, very good. I'm going to a related topic. We've been talking about transfers to the poor, and that we are very close to fiscal policy. Well, we have seen an extraordinary expansionary policy in the last 1.5 years. The question that follows that, what have you learned from this experience? We have a deep recession that was very successfully overdone by fiscal expansion. So what's going to happen in terms of the reaction, the fiscal policy reaction function? Is that going to be way more active in the future that we've seen in the past? I remember we had after the great financial crisis 10 years of or many years of discussion that monetary policy was the only game in town, and fiscal policy could do way more. Are we gonna do the other way around this time? Did we learn that we can do a lot of fiscal policy with very good consequences and very negligible side effects? Is that correct?
Yeah,
and what are the consequences in the long run of these new policy?
Well, one of the consequences of real interest rates being so low is that the cost of fiscal expansion in terms of an increase in the debt level is a lot milder than it has been in the past. I mean, it's pretty interesting if you look at the level of U.S. debt today compared to, say, 2007, and then you look at the level of debt service compared to 2007. The level of debt is tripled, and the debt service costs have gone up by something on the order of 15 to 20%. So we've piled on a lot of debt, but we're not actually paying much more for it. So there's been a change, as you know, in the economic orthodoxy that at very low real interest rates, fiscal policy is a lot less costly than it was in the past. And so I think it does mean that the fiscal lever is much more available to be used, assuming that the political process lets that happen. I mean, I think the special case in the U.S. is you've got this split between the Democrats and the Republicans, extremely polarized political state in the United States. And so we're in a situation right now where the Biden administration wants to use the fiscal lever on their infrastructure bill and on a much bigger bill to do a whole host of things to support lower and moderate income households. But it's not clear whether they can get that through the U.S. Senate. So I think, from a orthodoxy perspective, the fiscal lever is available. Whether the politics will actually support that being utilized, that remains to be seen at this point. But I think there's a risk here. I mean, it's not a free lunch. I mean, if you can use fiscal policy indiscriminately, then why do we pay taxes? So there's got to be a limit to how much fiscal policy stimulus you can lay on, how much the debt burden can go up. And one thing I do worry about, if in this current business cycle, the Federal Reserve turns out to be late, and the Federal Reserve has to raise short-term interest rates by more, then all the good news on debt service costs will evaporate pretty quickly as short-term rates rise to 2, 3, maybe even 4%. And so then the cost of the debt that we took on over the last decade will come due, and I think people will be surprised by how much that leads to a deterioration, a further deterioration in the fiscal outlook in the United States.
I see. So just to make clear, you don't think we're going to have in the next few years a too active fiscal policy due to the political gridlock that we have in place?
Don't know yet. I mean, I think the Democrats are trying to push through some big programs to, right now. Yeah. But they're probably going to not do particularly well in the midterm 2022 election. That typically the party, the president's party typically does poorly in the midterm. So you have to believe that, it's either now or it's probably not going to happen until, quite a bit later down the road. So I think there is certainly the appetite to do it, but whether political process will actually support it, I think remains to be seen.
But
the Senate being 50-50 is hugely important.
But my question is, suppose we have in the next few years some easing on economic activity that everyone, the public opinion will see as a problem.
I think it's available, but again, the Republicans would not be unhappy if the economy did badly, because they would think that would make it more likely that they would have a Republican president in 2024. And so, the problem we have with this political polarization in the United States is people aren't really on the same side in terms of what they're rooting for in terms of economic outcomes. The person who controls the presidency wants a good economy, and the people that don't control the presidency don't want the economy to be so good, and so that can lead to perverse outcomes.
Very good. Let me move to a different topic, one that was one of the favorite topics that people used to discuss at the BIS, that is the central bank digital currency. I remember you were part of these discussions that we had there. We had earlier today a presentation of the Central Bank of Brazil here, Roberto. He was outlining a little bit the idea of having a central bank digital currency in Brazil, and pointing out that he's solving a few of the problems, and it's advanced compared to other countries in this process. I'd like to hear your general views on what are the benefits and costs, what are the trade-offs, the consequences for the financial system, and how do you see that being implemented in advanced economies and in emerging economies? Give us some light.
I don't have the expertise to comment about emerging economies, but I think it's definitely coming. I mean, why does the currency, which is the claim, have to be in paper form? If it's in paper form, why can't it also be in digital form? I mean, digital currency, that's all you're talking about, is taking that paper claim and turning it into a series of zeros and ones in digital form. I think the tricky part about digital currency is really what's the role of the central bank in this? Is the central bank going to offer a digital currency, to all its citizens? So retail, or is the central bank going to offer a digital currency wholesale just to the commercial banks that interact with the Fed? And then how is that going to be disseminated down to households and businesses? The U.S. is very slow in this process compared to countries like emerging market economies and China. I think the Federal Reserve has really not gone very far down this path to date. That may reflect the fact that the dollar is a reserve currency, and the Federal Reserve wants to make sure that it doesn't, compromise that. It also may reflect the fact that there are some potential downsides to a digital currency. When people have cash, they can transact anonymously. And the question is, what happens if you have a digital currency? Will you have the ability to transact anonymously? And then if you do have the ability to transact anonymously, what does that say about the kind of nefarious activities that digital currency could potentially support? AML, BSA, Anti-Money Laundering, Bank Secrecy Act in the U.S. is really important. And so the Fed, I think, will have to think very carefully about how do you do a digital currency in a way that's consistent with still making sure that you're not supporting nefarious activities by bad actors.
I see. But concerning more specifically, taking the case of central bank digital currency to people, everyone has access to the central bank as a fraction of the central bank balance sheet. So instead of having cash, you have some account there, and I think the big question is how will these affect funding the financial system, funding of the banks, and how to deal with the possibility of very fast bank runs and things like that become much easier if you're not restricted.
Yeah, no, I think offering a digital currency that's available to everybody does run the risk of exactly what you've outlined. At a time of stress, everybody decides to convert their assets into the digital currency at the central bank because it knows the digital currency at the central bank is going to be safe. And in that environment, then you're going to have a huge liquidity problem, throughout your financial system, and the Fed's going to have to, respond by taking the money that it's received in those digital currency claims and recycling it back out by, lending into the economy. And that's going to be problematic, right? Because that would mean that the Federal Reserve would have a much bigger role in providing liquidity to support the private sector of the U.S. economy. That's the reason why I think that in the U.S. at least, the Federal Reserve is going to, probably try to figure out how do I keep our role wholesale rather than retail. In other words, we provide digital currencies to banks, and then the banks provide, provide the digital currency to their customers. And if customers can't run to the Fed for more digital currencies, they have to sort of go to their banks. So I do worry a little bit about some of the financial stability risks that you've outlined when if you actually had a digital currency available broadly, where people, every individual in the country had a digital currency account set up at the central bank. And I think the Federal Reserve is worried about that as well.
Very good. Moving to the global scenario, do you see any risks to the global economy that are coming outside the U.S.? How do you see this? All the news that we have from China, regulation, and this is a source of a drag to global growth and maybe a further risk aversion move that would affect the yield curve in the U.S. and everything. Do you see any other sources of risks relevant for markets in the coming months?
Well, sure. I mean, one risk is we're not getting the emerging market world vaccinated at the same pace as we're getting the developed world vaccinated. We need to get the whole world, at a high level of vaccination if we're really going to, reduce the COVID pandemic to, a level that, is a nuisance, but doesn't have a big impact on ongoing economic activity. So I still worry about that, the uneven spread of the access to vaccinations. The second risk you talked about, which is the risk of China trying to rein in their property sector. I'm not that worried about that risk because we've seen it in the past where China tries to step on the brakes. If stepping on the brakes has too big a consequence for their economy, then they ease off on how hard they are braking. And I think that will be the case this time as well. So it's possible that you could have a slowdown in China, but I don't think you're likely to have a hard landing in China because I think the Chinese authorities very much want to avert that. So I think, the pandemic and China, I think, are risks. And I think the other risk is just, what happens to global supply chains? I mean, I think we're finding out that having greater redundancy in global supply chains probably has some value. And if people view that as having some value, there's some cost to implementing that. And if there's some cost to implementing that, that has implications for productivity, has implications for inflation. And so I think there's a bit of a risk of, how do people want the world to look like going forward in terms of how they source their offshore production? And the last risk is sovereign debt. I really worry about the sovereign debt of some of the poorer countries around the world. That once we're past the period where you get some period where you don't have to make your payments on your debt. Now we're back to the period where the debt's now come due and the interest needs to be paid. I really worry that we could potentially have a bigger mess in the emerging market world. And one problem that we have there is we don't really have a lot of transparency in terms of how much is the debt, what are the terms of the debt, who do the countries owe the debt to, and we don't have a really great regime for restructuring this debt in a way that makes it sustainable going forward. So sovereign debt, especially for the poor countries of the world, I worry about the risk of a hard landing there.
Great, Bill. I think we touched every topic. It was a great conversation. I'd like to thank you very much and hope to see you again soon.
Thank you very much for having me. It's been my pleasure.
Thanks.